Hello and welcome to the GoNoGo show here on StockCharts TV. My name is Tyler Wood. I'm a CMT charter holder, and today, as always, I am joined by Alex Cole, the chief of charts over here at GoNoGo. How's it going, my friend?
Fantastic.
You look like you're ready for war, Jarhead.
Yeah. Well, once a year,
Yeah,
then you get ready for the winter hats. You don't have a bad headache.
smart move, smart maneuver. I've been having a bad hair day for about the last 10 years as it all just falls out of my head. Speaking of hair pulling moments, some investors caught off guard by the heavy selling happening at the S&P 500. Let's take a look at the charts, Alex, and see what's going on from an asset class perspective first, as we always do.
Yeah, absolutely. You can see the direction was made clear this week. Last week, we were sort of seeing that chop, and then we found the no-go trend, but that has really been strong this week so far. Uninterrupted purple bars, rallying a little bit today, but definitely still seeing some strong purple no-go in equities. Same for Treasury bond prices, continue in their uh, down trend. Of course, that's the opposite of what we'll see when we look at a rates chart, but Treasury bond prices in a no-go. Commodities coming back into painting a strong bar today. So that go trend continues, and the dollar as well showing some strength in its go trend.
Absolutely. Let's dive into a chart of just the S&P 500, the SPY ETF. Let's take a look at the price action first on a daily basis. And one of the comments that was made over and over again, actually, a healthy debate during the conference last week with the FX Evolution team in the US here from Australia. Got to see a lot of my favorite CMT charter holders there. And the argument was around anticipation, right? You need to anticipate the market's move, make sure you're positioned correctly. And I see a lot of folks commenting on what could have been a hammer candle on yesterday's price action. We had traded lower and then closed quite a bit off of the day's lows. So actually, we could even switch that into a really short term, like a 35-minute, 39-minute chart. If
Yeah,
you want.
let me put a candle on here too if you want.
Yeah, that'd be great.
That will make it obvious if I can. There we go. Let's see candles, and you'll see exactly what Tyler's talking about. This bar here looking like a hammer.
A very long wick down. And so the idea is with all technical analysis is that we're visualizing the behavior of traders in the marketplace. So throughout yesterday's trading session, the bulls regained some control, pushing prices back higher to close the day in a pretty narrow range to the open, but with that long wick down. Now,
Yeah.
the weight that we would give to an individual price bar or a candle pattern. First of all, you have to see the follow through, and we are seeing a bullish engulfing so far today. We haven't yet closed on the day here, Thursday, September 28th. But all of that being said, we've got a lot of people anticipating, price is going to come down to the 200-day moving average, and that's going to be an area of support. Maybe you use anchored VWAP as your position. The whole idea here with trend following or having a blended model is that absolutely whatever your time frame is and whatever your objectives are in the marketplace, you can place those trades however you want. It's helpful to have the context that the weight of the evidence is still showing us the S&P has a trend to the downside. We're still seeing profound negative momentum. We're at -3 on heavy volume. So we haven't seen the divergence on this daily view of the S&P 500 chart to say that momentum has come back so strong in a positive direction. We're looking at a trend reversal being imminent. None of those signs are on this chart.
Yeah. I mean,
So Alex, if you don't
yeah,
mind, let's pop it down to a 39-minute just to see
yeah.
that.
Just to follow up on what you just said, though, that we are seeing these counter trend correction arrows, which plays into exactly that idea of what people are talking about. We are in the short term expecting price to struggle to go lower, but that is because we're looking at this in a short term context. If you're looking at a candle pattern like this, you're thinking 2 or 3 or 4 bars ahead. The
Right.
larger trend is absolutely to the downside at the moment, right? We're in a strong no-go. Momentum is negative, but momentum has come off those oversold levels. We're seeing that counter trend correction arrow underneath the bullish engulfing. So, if you're thinking about the next couple of days, there certainly might be a little bit of relief, but
Mhm.
but the overall weight of the evidence suggests the trend is down on the daily. But yeah, let me just throw this out or actually bring it into a shorter time frame. We've got these great new time frames on StockCharts. gives you an even number of bars for the day. This is a 39-minute. Is that the one you wanted, Tyler?
Correct. Absolutely. So we can see that yesterday's price action closed quite a bit off of the lows of the day. And then we did have some follow through in the morning. Prices coming up. We see positive momentum on this much shorter time frame, 10 candles in a day's trading session. But here we are in the afternoon, right back at zero, testing for support from above and still in a no-go trend configuration.
Absolutely.
So the whole idea here is absolutely trade against whatever objective you are looking for. But from this point, it would be all about risk management, having tight stops under those prior lows, making sure that that you're managing your risk accordingly. Alex, the other piece of conversation that was really helpful in last week's conference, and then again recording the CMT Association's podcast, Fill the Gap, with a great technical analyst. Y'all are going to hear that in a couple of weeks. But we talked a little bit about the index construction itself. And the S&P 500 is a momentum strategy. It just has no risk management built in, right? We're cap weighting the index based on the largest market cap stocks. And it is a trend following strategy, loosely speaking, in the sense that there's a committee of people that throw out the names that need to be tossed out of that index of 500 securities. So to adjust our view on what's happening in the marketplace, right, rather than just what's happening in the S&P 500, we can look at things on an equal weight basis. So let's type in the ticker XVG, and we can pull that out to a daily time frame and start to see, actually, yeah, there we go. Let's give it quite a bit of history here. That bull market, the 2023 rally in the S&P 500, just has not shown up in the Valley Line geometric or in equally weighted constructions of the index. And what we're seeing is that the average stock is not performing well at all, and that we've heard from a lot of analysts about breadth and leadership being very narrow in this recent rally in 2023, that we just haven't seen broad participation. So the suspect, as the little kids are saying, the S&P 500 rally was sus to begin with. I think it's helpful to recognize the technical analysis can give us this kind of comparative lens. We can ascertain a whole lot of information from different constructions of the indices. But at the end of the day, we really have to make sure that we're understanding what is going into our indicators and what's going into our indices to make sure that we're looking at those data sets correctly. So this chart here, Alex, if we actually look at it on a weekly basis, the value line just has not rallied here in 2023. Yeah. We haven't seen the average stock in a bull market configuration. We've been very range bound.
Yeah.
Which is also to say that as we can never tell what the future holds, anticipating a sharp rally through the end of the year. If people are looking at seasonality, as many have tracked this year, it's been a very close correlation to what's happened in the marketplace. But placing trading decisions against the weight of the evidence, or defying our rules of buying into no-go trends to the long side, I think that's an area where if you are going to take that move, you really want to manage your risk very, very cautiously. Yeah. So let's take a look at what's driving some of these trends in the equity space, Alex. And once you get logged back into StockCharts, apparently you got booted.
That was interesting. Yeah. We didn't like that chart.
That's right. Too sloppy, too choppy, too range bound. Let's take a look at the TNX, Alex, in terms of a trend I would love to own. I wish this was a large cap name that we could put into our portfolio, but this is the 10-year Treasury yield. We saw that gap higher at the end of last week. Thursday and Friday began the very heavy selling in the S&P 500, and what a follow through again this week with strong go bars for interest rates.
Yesterday, really strong bar. You can see how we opened lower than the close from the day before and then closed higher. Struggling to maintain that move today. We did go a little higher, but we're sort of back where we opened. So very, very interesting. We're going to look at a few charts that is putting some pressure on equity markets. So, people, like you said, that are anticipating a rally into the end of the year. Well, let's just think, what are we actually seeing? And we're seeing some trends in some of our macro factors that actually might put some pressure on equity moves to the upside. And treasury rates continuing to move higher is certainly something that you'd think might have an impact on the stock market. And if we look at this on a weekly chart now, we can see that we are above that prior high. We've been talking for a while about how we were moving sideways, and perhaps the market's getting used to these kind of elevated rates, but now we're making a new higher high. So markets no longer perhaps stagnant in terms of rates, but setting a new high.
Absolutely, and it's not the level at which interest rates are at, but the rate of change and the speed at which they are rising. So that gap higher and then taken off again yesterday, certainly problematic for the equities markets, causing a little worry or uncertainty around just how much higher they can go and how fast they'll get there.
Yep.
So let's turn our eye to another very bullish chart, the dollar index. UUP is the ticker symbol we use here at GoNoGo Charts. It's an ETF proxy for the dollar index. That way we get a sense of volume trading around these levels as well. Alex, talk to us about what you're seeing.
I mean, almost a straight line, right? Almost a 45-degree line from bottom left to top right. And that's something you don't see too often. Of course, we see a little bit of weakness here with these aqua bars coming after some counter trend correction arrows. Of course, they're going to get flagged on the chart when momentum is overbought and comes back below the 5. Right now, we've seen extended period of momentum being in that overbought level. So with no counter trend correction just yet, but we are seeing some oscillator movement back towards that neutral area. But just strong go bars, new highs again on the dollar, and this one even more breaking out than the Treasury rates chart that we just saw. Right, that was just beginning to break out on its weekly chart. This one you can see we have broken out of that horizontal level of resistance, and we're actually now challenging these highs from sort of the end of the summer last year, early fall of last year. So a little bit of room to run, but we're actually getting close to these highs. So very strong movements on the dollar.
Absolutely. Let's take a look at USO. The oil markets. Certainly more conversation happening about energy and nat gas and oil over the last 3 months than ever before. Talk to us a little bit about what we're seeing in terms of the trend.
Yeah, I mean, this is another one. Looks very similar. So these are some really big macro factors that are all in strong go trends. Rates, the dollar, and oil. And you can, like you said, the energy market as a whole, but it's being driven by sort of oil and gas to a large extent. You can see higher highs, higher lows. You can see how the oscillator's primarily been supported by the zero line. You see trend continuation when it goes back into positive territory. And I've put these arrows on the right side of the chart here to show that that's what we're looking at again now. We had a little bit of weakness. We had a little bit of a pullback. We had the GoNoGo trend paint weaker aqua bars, telling us that there was some weakness in the Go trend. Of course, we then went higher again yesterday, repainting strong blue bars at new highs. Today, we've fallen away. So we're looking very closely now at the zero line to see whether or not the oscillator continues to find support. Of course, if the Go trend is to remain healthy, we would expect the oscillator to remain at zero or above. Positive momentum in a strong uptrend is what you'd expect. Any movement below the zero line would be a concern. So at the moment, we'd be looking to see if support is found, in which case we'd be able to suggest trend continuation for oil. So 3 strong Go trends when we look at those macro factors.
Absolutely. And why don't we take a look at gold real quick? And then we're going to move over to the commodities rel map and just see how these are performing concurrent with U.S. equities. But right now, the chart of gold in a no-go.
Yeah, gold not the same at all. Gold struggling every time it rallies, not remaining in Go trends for very long at all. So you can see the predominant movement here is down and then a rally and then down again. So these trends would have been short-lived. If you've been looking for gold to take off here, you'd have been quickly out of it once we saw the break below zero back into a no-go trend. Same thing here on the right side of the chart, really fallen quickly into a no-go trend. Max squeeze broken to the downside on heavy volume. So the market really participating in this movement down in price. We're seeing the market driving the price lower, and we're seeing heavy volume We're seeing the oscillator break out of a max GoNoGo squeeze, and of course now that's all happening at new lows.
Absolutely. And so now let's turn our eye over to the the commodities rel map, looking at the individual commodity ETFs relative to the S&P 500. When we're thinking about asset allocation and when we're thinking about diversified trend following, we need to know that there's always going to be a trend somewhere. It might not be in the areas where we're hoping or expecting that to be. So along this commodities rel map, we're seeing Brent crude in that second panel. Clearly outperforming the S&P 500 here for months.
Yeah.
But we're also seeing diversified agricultural commodities, DBA, in those strong blue trends of outperformance. We're seeing different commodities baskets, the DBC and DBB. We're also seeing, looks like steel, agricultural cattle. We're also looking at nat gas, SLX is steel, and then down there, USG, and even lumber outperforming the S&P 500. So this commodities rel map, we're seeing a lot more strength in the commodities relative to U.S. equities just over the last couple of weeks.
Yeah, I think that's the key takeaway, that it was oil for a few months, and now we're seeing a lot more diversification in the outperformance, relatively speaking, from commodities to the S&P.
Absolutely. Now, key point to make about all relative charts, when we're looking at those ratios, the absolute trend in something like GLD is to the downside, but it is going down less sharply or more slowly than the S&P 500.
Right.
And so when we're looking at any ratio chart and we're looking at the trends of those ratios, just keep in mind, this is for asset allocation, thinking about alternative places to position our portfolios when indeed there are sharp sell-offs in more high volatility or higher beta, riskier areas of the market. So, Alex, let's turn our eye away from all these commodities maps. Let's get back to the S&P 500 with our sector rel map. So we've talked a little bit about the value line geometric, about an equal weighted index, and seeing that the average stock has underperformed. If we don't give the weighting to those mega cap names, predominantly in our information technology, consumer discretionary, and communication sectors, start to see a different picture. So when we're looking at the S&P 500, back to that cap weighted basis, we can look at the sectors that are outperforming the index. And we have seen some changes over these last 2 weeks. What had been looked like a new rally in tech, the information technology sector, trying to come back in, rolling over sharply, pulling that index lower. Same thing with consumer discretionary in that second panel. Communication still holding on, as is energy. A lot of attention being paid to the energy sector. But we've also seen financials. So let's just stop and think for a second. We were in the midst of regional banking crisis, perhaps people's fears of systemic risk about financials generally, just back in March. So the fact that we're seeing this as an outperforming group now just tells us there's a lot to be learned. Market knows a lot better than we do about what's going on. So interesting to see financials outperforming. We also had a dip last week into utilities. Very defensive positioning ahead of last week's sell-off and into this week. Thankfully, that utilities outperformance has rolled over. When I say thankfully, I'm saying that the defensive positioning of utilities as our leadership tells you that there's really perhaps some bad news on the horizon, more investors positioning for further weakness. That was very short-lived. So, Alex, the next step in our top-down process, when we're thinking about asset allocation, it's great to understand the sector groups that are leading. But why don't we get into that communication sector that's been so strong and steady and take a look at the industry groups within that are pulling that sector group higher?
Absolutely.
So that top panel, the DJU SNS is our internet stocks of the communication sector. You probably wouldn't be surprised to think about the names that comprise that industry group. Names like Google, Alphabet, turning 25 this week. 25 years, Alex. Our kids don't even remember a time before Google.
Yeah, the one that gets me is the iPhone 10, right? That was like 10 years of the iPhone. I mean, now it's 15, just came out. And what my son's to 16, turning 17. I mean, phone does not mean what it meant to us. Telephone was
Not at all.
a word for a communication device with other people.
I'm pretty sure the first cell phone that I carried was a hand-me-down from my father. It came with a 9-pound battery pack, and I laughed at him when he offered it to me.
Yeah.
It was like I'm not in a bunker somewhere. I'm not trying to call in a chopper with like a 30-pound battery pack.
It's like those car phones in the
Right?
old days.
Totally, totally. The car phone. I
Oh,
love
we're
it.
so old. Anyway, let's
All
move on.
right. So we can look at these industry groups that are outperforming the sector, which is outperforming the index. And that top panel really catches our eye in terms of the strength and duration of the outperformance. And that's coming from the internet segment. So let's look at a couple of names within the internet area and just see what's happening from an absolute basis in those trends.
Absolutely. Who do you want to start with?
Let's start with a weekly chart of CDLX. That's a company called Cardlytics Incorporated. This is one of those smaller cap names that really has a very different looking picture from the rest of the market. And I think for a lot of our viewers, they're not thinking just about portfolio allocation. They're thinking about where they can find trade ideas. And so we're seeing that go trend. We're seeing positive momentum, very long-term downtrend, and really a base that's almost a year wide. As Louise Yamato taught us, the bigger the base, the higher in space, right? We want to look at those trends when they start to break out, not necessarily bottom fishing, but seeing something that has regained some momentum and some trend in the right direction. So we can jump into the daily basis on this Cardlytics company and see that there was a pretty sharp pullback last week, and we have strengthened this week into more recent trading. So perhaps a logical time to get involved in this security would be after that GoNoGo oscillator crosses back above the zero line. That's going to give us our confirmation that bulls are back in control. There's some enthusiastic buying. Right now, sitting below the zero line, that's not my favorite place to get involved on that daily chart.
Yeah, I know, but we did hold at a higher low, right? This
Yep.
was good here a couple of days ago, high low from back here. We also are resuming a path towards the zero line. We've strengthened to paint a stronger go blue bar. Like you said, of course, we're going to want to see the oscillator get back above positive territory, back into positive territory. If it does, then we could suggest a run and an attack on these prior highs and perhaps go higher still. But we would love to see that momentum positive. But there are some signs that we're turning around there on CDLX.
Absolutely. So now let's look at a few more familiar names. Let's pull up a chart of Meta, the owners of Facebook.
Yep.
And we have seen strength today. Certainly not looking like the chart of the general market in the sense that Meta has held up through this seasonal weakness of August and September quite well. We haven't seen the major drawdown. Now, as Dave Keller taught the whole audience, we need to be open-minded as investors to several possible scenarios. And when we think about that value line geometric, the average stock underperforming this whole year, really struggling to get into any kind of bullish environment. If mega cap names like Meta were to catch down to the average stock rather than the rest of the market catching up with these mega cap leaders, this narrow leadership group, then we could see a pretty sizable drawdown on some of these mega cap names, which would have very large implications for the index.
Yeah.
So this isn't prognostication. It's merely keeping an open mind to the fact that markets could move in any number of directions.
Yeah.
So if we narrow back in on this week's price action, we can see that we're building a max go-no-go squeeze. And for those of you who've watched the educational videos, we know that when we see that tug of war between buyers and sellers, when the market is in a period of real indecision, and just look at that narrowing of the price range, the fact that we've got lots of amber go fish bars, there isn't trend information coming out of the marketplace in a really clear fashion until today's bar. When we see the break of that go-no-go squeeze, that's going to give us an indication of who took control in that tug of war. And if it is to be the buyers, the bulls, then it's a comfortable place. where we have conviction in the weight of the evidence and the resurgence of momentum within that Go trend.
Yeah.
Right now, this single final bar here looks to be constructive, but I'd love to see the confirmation of momentum breaking off of that zero line in a positive direction.
Yeah, I mean, it's definitely an inflection point, and like you said, whichever way this turns could be quite important for the markets.
Mm-hmm.
Have to wait and see.
Not only is it important for this chart of Facebook or Meta, but also important for the market as a whole because of the cap-weighted nature of the index. Let's take a look at Google, turning 25.
Yeah, Google, similar picture, some uncertainty back to a go today, and the oscillator back at zero. So not riding the zero line like it was with Meta, but back at the zero level. So in both cases, the prevailing trend has been up. It's been a very strong trend for the internet services within the communications sector. So if support of positive momentum is found on both of these charts, that would be a good sign that we may be making an attempt at new highs. Of course, if that doesn't happen, if we get rejected here, if the oscillator gets rejected by the zero line or breaks down through that out of that squeeze on Meta, then these could hit new lows, which would, of course, drag the index lower, being how large they are.
Absolutely. So as we take our top-down approach and we're looking at the asset classes and then into the sector groups, then into the industry groups that are outperforming those sectors, even once we're down to the industry group level, not all charts look the same. Let's pull up a chart of ENV, Envestnet Incorporated. Also in the industry group, in the outperforming sector, has the glide path of a brick.
Yeah, I think that's such an important chart, Tyler. Such an important thing to note that, yeah, you can see relative outperformance in the communications sector, in the internet services group within that, but by ones that are in Go trends. It's like, couldn't be simpler, right? You see relative outperformance in a sector and a subgroup, but you wouldn't be buying something that's in a no-go trend. So even at that level, when you've gone down several times, not all is like you always say, forgive me if I plagiarize or misquote, but you always say it's a market of stocks, not a stock market. And even at the group level, it is a group of stocks. So pick ones that are doing well.
Absolutely. If we've got time for just one more, we saw in that industry group relative strength map that there was another area that was outperforming, and that's fixed line communications. Fixed line telcos are going to be names like Verizon and AT&T and all those cell phone providers that we love to hate whenever they drop our calls. And so outperforming the communications sector of the S&P 500. Let's just take a look at two names. Starting with AT&T, the ticker symbol is T, single T, and we're seeing some green shoots.
Yeah.
Right, the blue and aqua bars also at a moment of inflection, riding that zero line, building the go-no-go squeeze. But that attempt at a breakout, we did not make a higher high from that recent swing high back in July, but trend configuration tells us that this is gaining some constructive evidence.
And we broke above this level. There's a couple of levels on here that are of importance, right? This level was resistance, and it was also support over here. So we did break above that level, come back and look like we're setting a higher low, right? So we'll look for support here at the oscillator again.
Absolutely. And the other one to take a look at, Verizon, VZ. Very different looking chart.
Yep.
Very similar company, very different looking chart.
Yeah, absolutely.
So again, using technical analysis to our advantage, either for portfolio construction, if that's your objective, or for individual security trades, doing this kind of research and analysis is really important to get a sense of where you're going to find opportunities. For those of you who are working to the short side as well in your portfolios, a lot of utility right now with the no-go trends and being able to manage those short positions with tight risk. And be able to cover your shorts where we see those trends weaken. But from all of us over here at GoNoGo Charts, thank you so much for tuning in every single week. Alex and I are going to be with you throughout the fall and have some exciting things coming down the pike coming into the new year. So by all means, please stay tuned. And if you have any questions at any time, shoot us an email info@gonogocharts.com. And until next time, take care of each other and trade them well.